Bob Smith from Hawkins Delafield Wood, the village's bond counsel, Rich Tortora, Alex Locasio, and Diana Castaneda from Capital Markets Advisors, and your treasurer, your village treasurer, Irene Wu. And my name is Mike Sullivan. Just to set a few ground rules, again, the questions will be written on the cards. If you're on Zoom, you can send it via email to the St. Paul's. What's the Say it again. St. Paul's questions at gordonstee.net, at ny.net. Sorry about that. So this information session is going to talk about the various options to finance the future of the St. Paul's building. We're not going to get into discussions about the specifics of the Westerman numbers tonight. There's another information session next Tuesday at 6:30 in the same location, and that will be the venue to get into the weeds on the Westerman numbers. So with that, I think I will hand it off to Irene Wu to give a quick overview of the village's finances.
Okay, good evening, everyone. Thank you for attending tonight's information session. I also want to thank everyone on this panel for all the hard work they've put together for you folks on this presentation. So I'll be speaking a bit about the existing debt of the village. As many of you may know, during the budget presentations, we cover the debt service of the village. The debt service is the annual principal and interest that is due on existing debt. And we publish the debt service, the entire debt service of the village, with our budget document that is on our village's website under the finance department. We show all the debt that is due by all the various funds, the general fund, water fund, pool fund, and the tennis fund. As many of you may know, the water, pool, and tennis funds are enterprise funds. That means that the debt for those funds are covered through their operating revenues. So therefore, the only debt that really impacts the tax levy is the debt under the general fund. Currently, the village has about a little over 25 million of general obligation bonds that's outstanding in the general fund. With interest, that amount is about 29.6 million. In addition to existing debt, the village also has authorized but unissued debt. That means that the Board of Trustees has approved bond resolutions for various capital projects that we have not issued bonds for at the moment. Currently, we have about approximately $13 million of projects. These are 8 different projects in the general fund for which we have not yet issued the debt. The reason is we typically issue debt once the projects are completed to ensure that we are borrowing the correct amount that's needed. We typically issue bonds or go out and finance once a year. We will be doing that this upcoming February 2024. So most likely not all of these 8 projects we won't be issuing bonds for all these projects because these projects are in various stages of completion. Some of them haven't even started yet. So we'll be issuing a portion of this 13 million come February. As we issue new debt, we also analyze the impact to the operating budget. Our goal is to ensure that there's a level debt service annually so that there is minimal impact to the operating budget and the taxes that need to be raised. We typically fund capital projects through various methods. We take a look at each individual project. We look at the PPUs, that's the period of probable usefulness. So the longer term projects and the higher dollar value projects are typically financed. The projects with those shorter PPUs and the lower dollar value projects are funded through taxes. So when you look at our operating budget, we have two categories. We have capital projects that are funded through taxes, and in our 23-24 operating budget, that's about $4.1 million that we have allocated to fund those projects, those smaller projects. And then we also have debt service of about, $3.9 million to fund existing projects. So the combination of that is about $8.1 million. So when we look at the new debt that's being issued, we look at the debt service. Some of the debt is falling off the books. So any new debt will be partially funded through the reduction in the debt service. And then we can also fund the increase through the taxes. So we have a total pool of funds that we can allocate to fund capital projects. Also, in the last couple of years, the village has received federal funds through ARPA. ARPA is the American Rescue Plan Act. The village received $2.3 million over the last 2 years, and the village and the trustees have allocated about $1.6 million of that to fund capital projects. So that also helps to reduce our debt in the future, by funding those projects through the ARPA funds. I was asked a question about notes versus bonds. So the village has issued notes or bands. These are short-term, one-term year bans for the water well treatment projects. The reason the village has done that is because New York State has approved funding to help offset some of those costs. The 6 well sites that are being remediated, the total cost is about $55 million. And New York State has approved the village for $25 million in grants. So therefore, we won't issue bonds for the $55 million. We'll issue long-term bonds for the difference once we receive those grants. So that's why the village has used notes. That doesn't impact the general fund. We haven't issued notes on the general fund. I was also asked to speak a little bit about the credit rating, Moody's credit rating. Again, the latest credit report for Moody's is on the village website under the finance department. This report was issued in January of this year. We typically get a ratings call with Moody's prior to issuing new bonds. And as you all know, the village is AAA rated. And just a couple of highlights from the report, the village's financial position is healthy with ample reserves and liquidity. Credit strengths include high resident income, healthy reserves and liquidity, conservative fiscal management. They look at all the different metrics related to the village, the debt, the fund balance, revenues, the budgeting, and they discuss that in their report. In addition, they started rating the village with 3 new metrics. It's the environmental, social, and governance. Environmental is moderately negative, and that's because of the fact that we're in Nassau County, which has elevated exposure to storms and water issues. That's the only reason we have that moderately negative rating. But for social and governance ratings, it's very strong. We have strong employment, low poverty, high resident income under social, and then under governance, government operations are managed by certified and experienced professionals who are responsible for implementing policy objectives and, publish budgets and audited financial statements timely. So read, again, take a look at the Moody's credit rating report that's on the website. We'll be, of course, obtaining a new one this coming January as well. The other item that's on the slide is the current annual village tax burden for an average home. So as you may know, your taxes are based on your assessed value of your property. If you're not aware of what your assessed value is, it's not the fair market value. It's not the value that you will sell your home for. But if you're curious to see what your particular assessed value is, go on the village website. We have the link on the presentation. Take a copy with you. Go on the village website and look at the final assessment roll. You can, type in, it's a PDF document. You can type in your name or address, and the assessed value for your property will appear. So your taxes are based on that assessed value and the tax rate. So if we look at the tax rate, this is the latest tax rate for $1,000 of assessed value, which is $499.78. So if you multiply that by your assessed value divided by $1,000, you will come up with your individual, current annual village tax. I want to, specify this is just village taxes. I'm sure all of you are aware that our taxes, our overall property taxes, is comprised of, three components. It's village taxes, it's school taxes, and then we have town and county taxes, right? I think the breakdown is on average 50% of your overall real property taxes is school taxes, 30% is village taxes, and then 20% is town and county. So when we're talking about your tax impact, we are strictly speaking about your village taxes. School taxes is independent, county and town taxes is independent. They may raise taxes, a certain percentage, and that's incremental to what these percentages may be. So you may, be aware of this because over the last 2 years, the village has not raised taxes. It was a 0% tax increase on your village taxes, but you probably saw your overall taxes go up because, of course, school taxes went up and county and town taxes went up as well. So just keep that in mind. And I believe those were most of the topics that I was asked for. I think there are might be more questions that be covered after the presentation tonight. Feel free to ask questions if you have. I do want to, mention, bond counsel here on the panel and the folks at CMA Capital Markets. I work very closely with them. They are complete professionals. They are experts in their fields. I work throughout the year with bond counsel on bond resolutions, and especially when we, go out to market and finance, and with CMA as well. They're critical in assisting the village with, all the analysis that we do on our debt, as well as, when we go out to market. With our ratings call with Moody's, as well with all our required reporting. We have SEC reporting of continuing disclosures to the SEC, which they assist with as well. So they're very critical in all the work that we do in the finance department, and I appreciate all their help. So I think we'll continue the presentation now with Mr. Bob Smith. Oh.
How's that? Loud enough? No? Check 1, 2. Very good. Okay, that okay now? Great. Okay, welcome everyone. My name is Bob Smith. I'm a partner at Hawkins, Delafield and Wood. We specialize in municipal finance as throughout our entire practice, and we have served as bond counsel to the Village of Garden City for many decades. I don't know how many decades it is, but before I even arrived at the firm. So what I've been asked to talk about tonight is essentially the process, how the village issues debt, what limitations there are, and what hoops the village has to jump through. So jump into the limitations first. The village is limited because it's a village. A municipal entity has limitations that a corporate or a private entity does not have. The village is governed by the local finance law. That's the body of law that deals with issuance of debt in New York State. So there are 4 main things that I've listed out there in this first slide. Purpose, amount, term, and method of amortization are the main limitations that the village has to deal with, which again, if you were a private entity, you would not. The first one is pretty obvious. The purpose of debt has to be something municipal, and intuitively, you know what those are likely to be. This building right here, the roads that you drive on, the DPW equipment that's used by the village, anything in the office equipment, things like that. When they're financed, those are the things that the village needs. The village does not have the authority to issue something that will benefit a private entity or a private person. And that comes from the New York State Constitution as well as statutes that say essentially the same thing and codify what the Constitution says. The village is also limited in terms of the total amount of debt that it can issue. Then that's the constitutional debt limit. It's a very high number. It's one that you would never approach, and almost no village or town in New York City, New York State, would approach it. But it is 7% technically of the total assessed valuation of all the property in the village. I don't know offhand what the number is. I don't know if you know, Rich. There we go. You got to turn it on.
All right. So I've been waiting for someone to ask this fun fact. The village could issue up to $504 million of debt. That's 7% of your annual valuation over the past 5 years. Of course, that's separate. That would obviously have a credit impact, which we can talk about later on.
There we go. There we go. I figured someone would have it. Thank you. So that technically that's the limit, but you would never approach it. The things that impact on more of a day-to-day basis and when village issues debt are the term and the method of amortization. So term is the number of years over which debt can be paid or amortized. The term in the local finance law is period of probable usefulness, and that just means a statutorily determined likely period of life for a given asset. For example, a sidewalk improvement by statute can go a maximum of 10 years. Land acquisition can go 30. Sewer and water lines can go 40. There's a list of actually about 111, I think now, different categories of expenditures that are listed in the local finance law. So there's really no discretion in terms of the maximum period. Very often clients say to me, yeah, but I know it's going to last much longer than that. But this is statutory. So if the local finance law says sidewalks are 10 years, then sidewalks are in fact 10 years. So that goes into the bond resolution that we'll speak about momentarily also. The last bullet there is method of amortization. You see a term there, 50% rule, and another term, level debt service. Historically, we always had a 50% rule, and that means, and I don't want to get too much into the weeds for the group tonight, but the point is that there are limitations on how you amortize your debt. You can't have balloon debt, in other words, at the end. 50% rule, in a nutshell, means that no principal payment can be more than 50% higher than the principal payment in any prior year. So if it's 20-year bond issue and you pay back, I don't know, $100,000 in principal in year one, then no later principal payment can be more than $150,000. So obviously, if it's a $2 million issue, you're not paying enough principal. So the schedule and capital markets works with Irene to make those things work legally, and we review it before the issue gets done. So the purpose of that law is, as I said, you can't just backload the debt the way you might in a private enterprise where you're gearing up production or something and say, well, we're going to start to earn some revenues early and we'll pay the debt later. That's not possible in a town or a village or a county in New York State. Level debt service is the other option that came into the law in around the early 90s, I think, maybe the late 90s. That just means that we are authorized to set up the amortization in a way that's more similar, not exactly the same, but more similar to the way a home mortgage normally would be, where it's level. There'd be an expectation of rather than going from $100,000 in debt service one year to $500 down to $300 and up somewhere else, or graduating. It can be set up such that the debt service annually, principal and interest, is substantially the same. Bonds are authorized by a bond resolution. So that is, as Irene mentioned, we work throughout the year whenever the village is planning to finance something, whatever it may be. We draft the bond resolution for the village, and it's instructive, I think, to look at what goes into it. The law requires, and again, this is statutory, a statement of what's called in the law. The term of art is object or purpose, and that means what are you financing? Is it a building? Is it a truck? Is it a road improvement? Whatever it may be, needs to be stated, and that can't be changed. Once the resolution is adopted and bonds are authorized, the proceeds must be used for that purpose. It can't be changed later. There's also a requirement to state the estimated maximum cost of the project. And of course, that's another statutory term, estimated maximum cost. It means an estimate, it means the max, and it means the cost. So very often what the village will do is, if you think the project will come in somewhere between 200,000 and 250,000, the prudent thing to do is to authorize 250 and then see how the bids come out. And if it comes in at 200, that's great. That's all you issue. But the estimated maximum cost is what has to go into the bond resolution, which is separate from the principal amount of the bonds, which is the next bullet there. If that theoretical project is coming in at 250,000, but we're expecting grant funds, or we've already received grant funds to pay 50 of it, the bond resolution must state that. So that makes it clear to the public or anyone who's interested in seeing the bond resolution that even though we're issuing only 200,000, this project actually costs 250,000. However, we have 50,000 paid from another source, and there's a reason for that we'll get to in a couple of moments. Resolutions are generally required to be adopted by at least a 2/3 majority of the board, meaning the full voting strength of the board. So not counting anyone who happens to be absent for one meeting, or if there's a temporary vacancy in a seat on the board, the 2/3 of the full voting strength of the board has to vote in favor of the bond resolution in general. The one exception to that is what you see on the last line of this slide. A 3/5 vote is available where there's a mandatory referendum, meaning that, as we're going to speak about in a moment, bond resolutions are automatically subject to what's referred to as a permissive referendum, if the anticipated amortization will go for more than 5 years. So we'll speak about that first, and then we'll harken back to that 3/5 vote. So the slide that's up there now, I assume, is the permissive/mandatory referendum. As I said, this applies where the maximum maturity of the bonds that you're authorizing in that resolution exceeds 5 years. And I should point out that very often at the same evening, in the same meeting, the board will adopt more than one resolution, simply because that object or purpose that I mentioned before, that statutory term, means that you need a separate bond resolution for each purpose. So if the village is authorizing DPW trucks, road improvements, and building improvements all on the same night, we're required to have 3 separate votes and 3 separate 2/3 votes, 3 separate resolutions, 3 separate statements of maximum amortization period in those resolutions. And that's why there are at times more than one bond resolution on a given agenda. A permissive referendum means that there may be a referendum, but only if it's requested by petition by members of the public. The standard is that if a petition is received by the village clerk, signed and verified, etc., by at least 20% of the total number of registered voters in the village, then there shall be a referendum on that particular resolution. The referendum is not on the project. The referendum is on the issuance of debt for the project. So the project could be done without debt if it's defeated at referendum. However, it's important to note that the voting is on the indebtedness or the authority to issue indebtedness. So there's a 30-day period for doing that. So procedurally, what we do is the bond resolution is adopted. As part of that resolution, there's an exhibit to that resolution which contains a notice that shall go in the newspaper. It has to appear in the paper within 10 days after adoption, and assuming that it does get in within 10 days, then a petition must be received within 30 days after the date of adoption in order to be valid and to call for the special vote. The vote has to be held. It can be held in kind of a wide area. Is it on the question of authorizing the bonds? It has to be at least 10 days later and not more than 60 after the petition is received. It can be done at the general village election if there's a general village election upcoming. So if you look at the bottom of that slide, it refers to a mandatory referendum, and that's what I suggested in the last slide. If a mandatory referendum means there won't be a notice published, it's not that the public has to come in with 20% signatures to come in and ask for a vote or demand a vote. The board can just decide that there will be a mandatory referendum. We shall have a public vote on this resolution. And the village has done that in the past at times. It's infrequent, but sometimes the village does do that. So that means the bond resolution will be adopted. It only needs, as I mentioned on the last slide, a 3/5 vote if there will be a vote on it. And then there's no publication of kind of that the resolution is adopted. It's really a publication that says we shall hold a vote on the authorization of that debt on a given date, which will be, as I said, within 10 to 60 days after adoption. So that's the authorization process. There's, going back, there's a project, there's a bond resolution adopted per the statute. There's a publication either telling people that it was adopted subject to a permissive referendum or stating that there will be a mandatory referendum on a given date. We get to the point where the authorization has happened. I like to mention in a presentation like this, the special statute of limitations that can apply to a bond resolution. This is in the local finance law also, is referred to as the estoppel publication because legally it estops challenges. If you're familiar with general village or municipal law, you would know that the usual statute of limitations is 4 months under general procedural law for any action taken by a public body. So to challenge, you have to bring your challenge within 4 months in general. I'm sure Gary Fishberg and others could tell me exceptions or other things that we should be thinking about, but that's a general rule. There's a special statute that says in the local finance law, if a town or a village or any municipal issuer puts a separate publication in the newspaper, which is referred to as that estoppel notice, that 4 months is shortened down to 20 days. So it's less than 3 weeks to have exposure to lawsuits, and it's important for the public to know that. It's important for the board to know that. So I always like to mention that in this type of a discussion. It's not required. The village does not have to publish that notice. Generally, a municipal issuer will issue it because it gives more certainty to the timing. The purpose of that whole law is really to keep projects on track. That's why the legislature put this in many years ago. You can imagine if you're doing a project, especially if it's weather related, and a lot of capital projects are outdoor projects and need excavation, they need outdoor construction. And if you adopted that bond resolution, say it's September, and then you had to wait 4 months to see if anyone was going to challenge the bonds, you might miss a whole construction season. So that's the reason why it's in the law. But I'd like to just mention that it exists. Final point on bond authorization, and from my point of view, that I've been asked to speak about is federal tax exemption. A village is a municipality for federal tax law purposes. That means that you're a public entity that can issue tax-exempt debt, meaning that the interest on the debt will not be taxed to the holder of the bonds. That provides a significant advantage to a municipal issuer because a corporate or a private issuer would issue debt that is taxable. So your purchaser of that debt will pay taxes in general on the interest earned. So that's what tax exempt debt is. Now, in order to do that, the village has to follow certain IRS rules. It's all governed by the IRS rules. There are two main things, and it's much far beyond the scope of what we should be speaking about today to get very much into the details. But two main things that affect private use of bond financed facilities are what we should be speaking about today. Where the village, as I mentioned earlier, the village is authorized under state law as well as federal tax law to issue debt for public purposes. Now, there are times when you will be financing something that has some private aspect to it. For example, leasing a building or taking rental on a building, or having some kind of payments coming to the village from a private entity that's using some portion of a building is a good example. That can happen. But as you see here, and this is very, very general. I'll warn you, it's at 10% generally, and some circumstances 5%. Let's not focus on that kind of minutia, but those are very, very general statements of the requirement that at least 90 to 95%, and generally 100% of any bond finance facility is going to be used by the village and not by anyone else to preserve the federal tax exemption. And this comes up at times when there are public-private partnerships proposed and things like that. It's not impossible for a village to issue taxable debt and just determine that there's a business reason to issue the debt anyway and not have the advantage of tax exemption. But that's item number one on private activity. Is the general umbrella consists of private use and private payments. The private payments means that the source of payment for the debt service on the tax-exempt debt is coming from a private entity. And again, it's a similar rule, and I'll throw the same caveat out there, very, very, very general statement of it. But in general, all of the money being used to pay debt service of the village is coming from either property taxes or other village revenues, and not from any kind of a private entity. So those are the two big issues on tax exemption that I just wanted to mention this evening before we move on to some of the scenarios that I think Richard and others from capital markets will start to speak about. So, I should mention also that there's a question that came in by email earlier talking about some of the other materials that went around. Talked about these scenarios such as demolition of the building. I mentioned periods of probable usefulness earlier. There's the PPU, or the period of probable usefulness for demolition of a building. There is one in the law, is 10 years for a municipally owned building. So the question was, if the period of probable usefulness is 10 years for demolition, if we're going with the facadism that we'll speak about later, why is that longer? The answer is that demolition of the building in whole or in part would be considered its own project if you're doing only demolition. If you're putting the two together, demolition and construction of something new, there's not a need to bifurcate it, and you can have the longer period for the demolition as well as the construction. So I guess maybe leave it to Richard to start going through the scenarios that are listed in the program, and we'll come back to some of the other specific questions later as they come up.
Okay. Can you folks in the back hear me okay? Great. Thank you. I'm Richard Tortora. I'm the president of Capital Markets Advisors. We work with Bob's firm, serves as bond counsel. We work as the independent financial advisor to approximately 350 jurisdictions across New York State, including most of the largest cities, the largest counties, but for Nassau. And we advise them when they need to issue debt to fund capital projects or cash flow needs. Regardless of what the board and the citizenry eventually decide to do with the St. Paul's property, it appears apparent that you're going to have to issue debt to fund it. So our job is to talk about how you would issue debt, what type of reception you might get from the market, from investors, and what the debt is going to cost you. I mean, when we are involved in projects like this and presentations like this, it really comes down to two things. What am I getting, and what is it going to cost me? So we can't answer the what are you getting part. That's for a different conversation, but we can talk about what it will cost. So slide 7, the heading on slide 7 is financing scenarios, adaptive reuse, facadism, or demolition. So you're going to be involved in maybe 1, 2, or one or two of these particular uses of the property. The facadism, if indeed the village needed to issue debt under the current local finance law and with its current constraints, the existing building, the St. Paul's building, is a Class B building. And Bob talked about the period of probable usefulness. The way I like to talk about period of probable usefulness is how good is a capital improvement? How long is it good for the purpose for which it was intended before you have to either replace it or substantially reconstruct it? So a Class B building has a useful life, a period of probable usefulness of 15 years. So if you were to issue debt through the village, which you're currently allowed to do, for the maximum useful life of the building, you'd have 15 years to repay that debt. We talk about debt service. What debt service is the principal and interest payments that you make each year on debt that's outstanding. You'd very likely issue serial bonds for this project. Serial bonds, as the name implies, mature serially. Every year, you make a principal payment. Every 6 months, you make an interest payment. You have to start paying back principal within 2 years from the initial issue date. You have to start paying back interest typically within 12 months from the initial issue date. So presently, the village could issue 15-year general obligation bonds to fund this project. What a general obligation bond is, basically it tells investors that the full faith and credit of the village will be assigned to the repayment of this debt. So any revenues that the village have, whether they be fee income or it's real property taxes, which is your primary revenue stream, you can pledge that revenue stream. You will pledge that revenue stream to the general obligation purchaser of your debt, which makes it the most secure debt out there. Other than U.S. Treasury securities, municipal bonds issued by AAA rated credits, which is what you are. You're rated in the AAA category, which is the highest credit rating that Moody's Investor Service puts out. So you're kind of a gilt edge credit. What that means to you is when you go in the market, there's going to be a lot of appetite for your debt, and you're going to get the most attractive interest rates available. For example, earlier today, we advised the town of Greenberg on a rather large bond financing. I think it was about $25 million. Diana ran the sale. They received 14 bids, and the interest rate between the highest bid and the lowest bid was within 16 basis points. When we talk about interest rates, we talk about basis points. There's 100 basis points in 1%. So 16 basis points is just under a fifth of 1%. So a very tight spread between the winning bidder, I think was a 381, and the highest bidder. So again, what you can presently do without any legislative changes, et cetera, is issue 15-year bonds to finance the reconstruction of the building. Alternatively, if we were looking for a longer useful life, what we've done in the past, for example, we did this a couple of years ago with the city of Long Beach, when 15 years posed too much of a burden on the residents because it was just too much annual debt service for them to absorb. It just hit the tax rate too high. What we did in the case of Long Beach, we petitioned the state legislature, and they adopted a law that allowed us for this particular project that we were involved in to issue debt for 30 years. So if you're paying back debt 30 years, just like a mortgage, a home mortgage, your principal and interest payment is going to be a lot lower annually or monthly if you're paying it over 30 years than if you're paying it over 15 years. So a second possible financing scenario would have the village go to its state representatives and see if they can get special legislation to extend the term of the debt from presently where it is 15 years to 30 years. They would do that to reduce the annual debt service payments to the village residents. Alternatively, we could, rather than issue debt through the village, we could issue debt through a third party, through a conduit. The conduit could be, for example, the Nassau County IDA. The IDA is in the paper from time to time. They issue debt on behalf of not-for-profit entities, maybe their economic development engine. So you could potentially issue debt through the IDA. The reason you might want to consider doing that is the IDA is not constrained by the local finance law. So the IDA doesn't have a 15-year term on its debt. It could issue 30-year bonds or longer if it needed to. the problem with the IDA, of course, it brings a whole nother set of players in. The IDA bonds would be revenue bonds. The revenues that are generated by the facility would be used to pay debt service on the bonds, which is very different than primarily real property tax revenues, which is your primary revenue stream when you're issuing general obligation bonds. The other thing to talk about on the bottom of this page, we talked about the demolition. As Bob said earlier, the demolition of the building would have a 10-year useful life. You could issue debt on your own through the village 10 years to finance the demolition portion of the project. If you go to the next slide, just to give a little more detail now in terms of if indeed the village were to issue general obligation bonds on its own, you would certainly benefit from your AAA credit rating, the highest credit rating you can get. We're making an assumption that the bonds certainly wouldn't be issued this year. They probably wouldn't even be issued next year because it's going to take you some time to figure out what you're doing. Once you do figure it out, just for purposes of the debt model that Alex constructed, we assumed bonds would be issued in 2025. We also made an assumption as to what the interest rate would be. We're presently in a relatively low interest rate environment for tax-exempt bonds. 2 years ago, 3 years ago, 4 years ago, we were in an extraordinarily low interest rate. If we were doing this project 3 years ago, we might have been able to issue 15, 20-year bonds at 2%-ish. Presently, you could probably issue 15-year bonds, maybe at about 3.75%, still very attractive. However, since we're not in the market today, we'll be in the market some in the future, for the purpose of our modeling, we added 80 basis points or 0.8% to the rate. So we made an assumption if the village were to issue 15-year bonds in 2025, we're going to assume it's going to be an interest rate of approximately 4.20%. Still very attractive for relatively long-term debt. The final maturity on that deal would be T40. Total interest expense on $50 million in debt over 15 years is that $18.9 million. Even though the interest rate's very low, you're borrowing it for 50 years, a significant amount of principal. That's what it adds up to be. The pros of general obligation debt is your lowest cost of capital, lowest issuance cost, lowest interest expense over the life of the issue. No special legislation would be required under the 15-year scenario. And the village would control its own destiny in terms of when it entered the market. If you use a conduit like the Nassau IDA, or let's say the Nassau IDA, you don't have as much control. You certainly still have a great deal of control, but not as much control because you're working with a conduit. The cons of a 15-year deal, since the maturity of the debt would be limited to 15 years under current law, the burden on you would be higher than if it was 30-year debt. You'd be paying it off over 15 years. And as it says here, the tax impact to residents is severe due to the relatively short term of the debt. That table let me have Alex, would you walk them through the table on the right, if you would?
Sure. So this,
I have this right here.
okay. So we're looking at the impact of issuing such debt compared to what your current tax levy is in 23-24. The burden per thousand of assessed home value would be $42.89. What that looks like is if you have a house assessed or property assessed at $18,300, your increase compared to what you're currently paying in taxes for the village would be up $784.80. This is an increase to the tax levy of 8.58% into your taxes as well.
What that table shows you is three separate values of property. The property assessed at the second level, the property assessed at 12.2 has approximately a fair market value presently in the open market of around $1 million. Property assessed at 18.3 has a value of approximately 1.5 million. Property assessed at $2 million. Assessed at 24,400 is 2 million. But as Irene said, I think you can go on the village website and get a better sense of what your property's assessed valuation is. If we turn the page to the next slide, this is a scenario if indeed, again, we were issuing general obligation bonds and taking advantage of the village's AAA credit rating would have to go to the state legislature. So you'd have to work with your assembly person and your state senator, have legislation introduced. If indeed we can get the PPU, the period of probable usefulness for this particular purpose, extended from 15 years to 30 years, your cost of capital, of course, goes up because you're issuing longer term debt. So the $50 million over 30 years, your total interest expense is now $45 million to carry that for 30 years. Your final bond maturity would be 2055. The pros of going this route, the annual impact to the taxpayer would be less because you're spreading the debt repayment over 30 years. Again, since you'd be issuing as village debt, it would be lowest cost of capital, not as low as the 15-year debt because it's the shorter term, but lowest interest costs, low interest expense over the life of the issue. And again, since it would be a village general obligation issue, very strong market support, and you would control your access to the market. Again, the con in this 30-year scenario would be the village would have to go to the state legislature and get the legislature to approve a new law that says for this particular purpose, you can issue 30-year debt, which is certainly, we think, doable. It should take some time. It's not guaranteed, but it's not without precedent that you can get on an iconic building like St. Paul's that you could get an extended PPU. The next page talks about a potential structure. If, for example, the village didn't want to issue the debt on its own, maybe in part because it's concerned about issuing so much debt under its own, even though, as Diana said, you have the capacity to issue a great deal of debt here in the village because the value of real property here is so high. Regardless, if for one reason or another, the village said, we don't want to issue it as our own debt, and we want that longer useful life, we want to issue 30-year bonds, we could issue through a conduit. To do that, a likely scenario is that you would set up a not-for-profit entity. Perhaps the land would be sold to them. They would lease it back to you, and then the lease payments that the village would pay to the not-for-profit would be equal to what the debt service is on the bonds. It's just a financing technique. In that instance, because you don't have the AAA rating, your interest rate is going to be higher than if you issued it on your own as general obligation debt. 50 million cost of interest over the life of 30 years is about $54 million in interest expense. The pros that you're using this scenario, reduce annual tax impact because of the longer principal amortization. It would not be direct debt of the village, so it would have a lesser, if any, impact on the village's own credit rating. You wouldn't be constrained by the local finance law in structuring your debt. The cons, the costs of issuing through a conduit are significantly higher. There's a whole other layer of attorneys, of advisors and trustees. The interest expense would be higher. We talk on later pages that while issuing debt directly, we think your expense might be somewhere in the neighborhood of $115,000. Issuing through a conduit, we think it could cost as much as $780,000. So a multiple of what your expense is issuing general obligation debt. One of the things I mentioned on the bottom, if indeed the structure of debt issued through a conduit necessitated a mortgage interest in the property, if that was part of the credit structure for the deal, that could be a dead end in itself, because very often the property would have to be appraised at a value equal to or greater than the amount of debt that's being offered to fund it. So, for example, if you were issuing $50 million in debt, that property would have to be appraised at $50 million. I don't know, maybe it could be. I mean, it's in Garden City, it's a big piece of property, but that's not my area. The next page, slide 11, again, talks about the demolition bonds. If indeed you had to issue demolition bonds and the idea was just raise the property, as Bob said earlier, that would have a 10-year useful life. The estimated cost of just raising the property, just getting rid of everything that's presently there, would be approximately $13 million. You'd pay for that over 10 years. Your interest expense would be approximately $3.67 million. Those bonds, if issued in 2025, they'd have a 10-year term, so they'd be done in 2035. Again, these would be general obligation bonds of the village. You'd benefit from the AAA credit rating. No special legislation is required. It's your deal. You would have control over the timing and the structure of the deal. The cons, of course, it is a short useful life, so you'd be paying for it over 10 years. And so that would hit your tax rate. And the tables on the right on each page talk about what the actual impact is of the various borrowing. That next slide is just a comparison of different scenarios side by side for a $50 million borrowing. It lays out the information that I spoke about in terms of when the maturity of the debt would be, what the overall interest expense would be, what the increase to the average homeowner would be, et cetera, et cetera. You all have these on your handout, so I won't go into this in much detail unless it comes out in questions.
I will say we do compare the 50, 75, and 100 million because the costs aren't entirely set. It also, depends on what you all as residents decide to do once these first phases have been completed.
If we can jump to slide 16 for a moment. If indeed the option that the village goes forward with involves construction of a new building, of course, there'll be operating and maintenance expenses associated with that building. And again, we don't know what we're building, so we just use plug numbers of $1 million annually to $2 million annually. And the table on slide 16 shows what the impacts of those dollar amounts would be per thousand, and then for the three assessed valuation categories, 12.2, 18.3, and 24.4. That's just for the operation and maintenance expense associated if you go with a reuse or facadism. Page 17, whenever we do presentations, especially with a credit like Garden City, we like to tell you how important it is that you have a AAA credit rating. So what this table says is there's no greater impact on your cost of capital, how much money costs you, than what your credit rating is. Term of the debt is important. The amount of debt that you're borrowing could impact the cost of capital, but the most important thing is your credit rating. So prior to joining CMA, Diana was a credit analyst at Moody's Investors Service. And I present to Moody's every once in a while, and I try to tell the analysts how important it is what they do, because it really impacts my clients in terms of their access to the market and what money costs them. So what this table on slide 17 shows, so the table is headed credit quality and cost of capital. And the table to the right talks about where interest rates are as of 9/21, so last week, based on credit quality. So for example, if you were doing 15-year bonds, which is what you're legally allowed to do, with your A credit rating, as of September 21st, those 15-year bonds would probably have a cost to you of around 3.67% at a AAA. If you were in the AA category, your cost of capital would jump to 3.91%. If you were a single A, you'd be at 4.16. And if you were a BAA, you'd be at 4.62. So it's important to know how the credit categories work. The best you can be is AAA. Right beneath that is a AA, and then they have modifiers, 1, 2, and 3. So a AA1 is just one notch under a AAA credit rating. Then there's a AA2 and a AA3. Beneath that is a single A with modifiers 1, 2, and 3. And then beneath that is BAA modifiers 1, 2, and 3. So there's 10 credit ratings above investment grade. Once you get below BAA3, you're sub-investment grade, or what they call junk bonds. AAA credit rating is something you have to jealously guard. It's very hard to get. Once you get it, it's typically not that hard to keep because everything has to be going right just for you to get it. So kudos to you that you were able to get a AAA credit rating. If indeed you use it to finance this project, this is one of the most significant projects probably in the village's history, it's going to serve you well. So that's basically what we wanted to talk today about, the financing. There's other breakdown of numbers in the appendices, but I think with that, Irene, are we open to questions?
So there have been some questions that were submitted to the website earlier. I know the mayor is passing around cards now. While we're waiting for that, maybe Paul Blake is going to just say a few words about the O&M costs that Richard mentioned. Paul has put a little bit of thought into, what that number might be and how we arrived at the range we did. So here's Paul.
Thanks, Mike. Good evening, everyone. These numbers were kind of pulled out of thin air, but they're based on some actual numbers. We took a look at the programs that we currently run throughout the village and how many of those might fit into the space which we were given to work with. And we found that we have about 10 programs right now that could go in. We were given 6 spaces in the building to use. We estimated we could fill them with 8 classes a day. Then we dropped it down to an 80% rate. What we came up with, 48 sessions per day. Our salary is part-time for a basic instructor. A basic instructor is the person that's out on the court with 3 little kids showing them how to hit the tennis balls. Or they've got 10 dance students and they're showing them a particular routine. We anticipate that hourly salary will be about $28 an hour. So that came up to a yearly cost of $147,470. Now, we also have what we call advanced instructors. And these are the people that coordinate the lessons, do the lesson plans, and they're the ones that are out telling the 3 instructors what they're doing and how to evaluate them. We figure them at about 2,713 hours at $40 an hour. Now worked out to $108,528. So the total on instruction from staff members would be $255,998 annually. Now, it sounds like a big number, and it is. It would be offset by a revenue number equal to or greater than that, because we charge for our classes. We don't run classes that don't pay their own way. If we need 10 students in a class, we put 10 students in the class. The other things that we came up with were just some general numbers in terms of maintenance for the building. And we found that if you go online and do some research, one custodian in an 8-hour period can clean about 13 to 15,000 square feet. So knowing that we're going to want some of these rooms cleaned more than once a day, in discussing things with our maintenance foreman, we came up with 2 custodians for the building and 4 maintainers, 2 shifts of 2 each. That'll give us people that can keep the building clean, can attend to small repairs, painting, touch-ups, electrical, stuff like that. And that is all figured into the final number that Mike has here. I think that's all I had.
Thanks very much. So we have a few more questions that I think Irene will address that came in on the website. Would you like to talk about it now? Maybe read the question first and then respond.
Sure. Okay. So a question to come up regarding there's a debt analysis presentation that's on the village website. It was something I prepared. I was asked to prepare by the Finance and Audit Committee back in 2020. So at the time, the village was beyond St. Paul's. So prior to that, the village really wasn't spending much on maintenance. There was no HVAC or electrical or any type of other maintenance expenses that were spent on the building. It was very immaterial, the amounts. I think they would just replace certain windows as they were broken, or, just do minor things, put up lighting. I think flood lighting was put up around the building, but nothing major over the last 10 years. And then I received a question regarding a sentence in the presentation. The village expects to issue approximately 13 million of general obligation bonds in the 2024 fiscal year. These bonds are currently authorized but unissued and will likely cause only a nominal increase, if any, to the village's current tax levy. So how can issuing $13 million of bonds have a nominal increase? So again, as I explained previously, due to the fact that some of these projects have not started yet, we most likely at this time, we're speaking 5 months in advance, but at this time, we most likely will not be issuing the full 13 million come February. It would be a portion of that. Again, the other thing I explained earlier was that we do have debt that's dropping off. So our current operating budget has a budget for debt service. That number automatically goes down the following budget year. So some of those reductions will offset some of the increases in the new debt that's coming on. And also, the other item I mentioned was in the operating budget, we also set aside about $4 million to fund projects through taxes. We may not need that. Looking at the existing capital 5-year capital plan that we have, we may not need that for full $4 million to fund projects in the next budget year. So we can take some of that funding to offset the increase in the debt service. So that's why that comment is there. Okay. And I think that's all for now.
We can go to a couple of questions that we received in the room here. This one said, bond capacity analysis to maintain AAA rating. What were the spreads for the town of Greenberg?
What were the spreads for Greenberg?
Yeah.
Interesting. I don't recall what the spreads were for Greenberg off the top of my head. So again, we use industry benchmarks. The table that I showed you, I think was on slide 17, is something called the MMD scale, slide 17. And when we price bonds, or when bankers price bonds, they look at your credit rating, they look at the size of your issue, and they price typically off the AAA scale. So Greenberg, do you have that?
Yes. So the town of Greenberg issued 14-year bonds. As Rich mentioned earlier, there were 14 bids. So this is last week's MMD scale that's up on there. The winning bid came in at, oh my God, I can't see, 351. And if you look at the 15-year rate as of last week was 367. It came in slightly. I believe today's rate was 361. So they did very well. And to Rich's point, that this was, people want AAA paper. There's hundreds of a basis point separating the top 3 bids. And that's what we would expect. And that's what we see when we sell bands for Garden City, for the Greenbergs. It's money good in people's eyes. So it does very well in the market. Yes. Yes, you also get premium, which, without getting into the weeds, we use that premium to downsize the bond. CMA is one of the few municipal advisors that does this, so that you pay less interest because it's a lower par. And then any excess premium is used to make debt service payments.
The last part of that question is scenario analysis available on cost of debt? And I think the answer there is that we didn't do a scenario analysis, but you had the 80 basis points to the spread, correct?
Right. There's no, what is it at 30 basis points or 130? It's just 80.
Diana, will you still have the microphone? Next question. Moody's says GC leverage from debt is rising. Is this a barrier to future debt issuances?
So that's a great question. So, and I had a note here on that slide 17 that's up. Your debt levels are 23% above the AAA median. However, caveat, tax supported debt is modest. That's that 25 million that Irene mentioned. And the offsetting factor for someone like Garden City is that so right now your debt levels are, what did I say? 23% above AAA medians, but your resident income is 248, whereas the percent above the U.S. area household income, whereas most AAAs are 120% above. So it's your wealth and the socioeconomic factors here that enable you to take on additional debt. That really is the driver of the AAA rating and what makes your credit so special. I don't know if you want to add anything, Rich.
And your wealth inherently, it's the real property values. The real property values here are very strong. They've held up very well. And because they're so strong, Moody's puts out a scorecard. So when you go to Moody's to get a credit rating, they actually fill out a scorecard for you. And it says, okay, this is where the rating comes in based on the scorecard. But there are extraneous factors that aren't within the four corners of that scorecard that could make your rating go up or down. And one of yours, or a couple of yours, are the extraordinary real property value and the extraordinary income of residents living in the village.
Following up on that, I'll read the question out on documents on pages A1 and A2. There's a reference to a call feature, and they give an example: an 8-year call for 30-year general obligation with legislation, and then a 10-year call for A3 for the 30-year conduit. Please explain what does the call mean?
Sure. So when we issue serial bonds, long-term debt, we reserve the right for the client, the issuer, the Village of Garden City, to call those bonds at any time after 8 years. So, for example, if you were issuing 15-year bonds, starting 8 years out, you could call all the bonds maturing in years 9 through 15. You could call them in at par. So you wouldn't be paying a premium to an investor. So if you were calling in $1 million worth of bonds, you'd be paying $1 million for them. The reason you would do that, if interest rates were lower today than they were when you issued the debt, you could refinance them and go from higher interest rate coupons to lower interest rate coupons. Another reason why you might call the debt, you might want to restructure the debt for some reason, or perhaps you get a slug of money in, for example, ARPA funds. We had a lot of clients that received the American Rescue Act monies for the COVID relief monies over the past couple of years. We actually just had one of our clients, Suffolk County, paid off some judicial facilities bonds. There was maybe $40 million in bonds outstanding. They did analysis and they said it would be a good use of a portion of their ARPA money just to call those bonds in and pay it off. So again, a call feature, exercisable at the option of the issuer to call in and pay off that debt, typically because they're going to pay it off or they're going to refinance it at lower interest rates.
Thanks. There's a couple of questions on the level debt service. Maybe I'll read both questions, and you kind of touched on it earlier. All the figures in this report were based on the level debt service basis. Hopefully you will explain how it works and why you were using the level debt payment method. And the other question is, leveling is mentioned in Appendix A1 through 4 with respect to the debt service per year for several bond durations. Is this to even out yearly taxpayer costs so as not to unfairly burden residents such as seniors who may not be residents for a substantial part of the debt term? Please explain leveling.
Yeah. So question 2 kind of answers question 1 a little. Right. The reason we do level is that the tax burden stays the same throughout the entire life of the bonds. If you can lower the total interest cost by paying off debt faster, increasing the principal size. However, your tax impact would go up. So those figures that we have for, comparing 15 years to 20, your tax levy in 2023-24 would be substantially higher than the $785 increase to your home taxes.
As Bob mentioned in his opening comments, the village is constrained by the New York State local finance law. You can pay back debt structured typically 2 ways, either level debt or 50% rule. For the last 15 years, I'd venture to guess 95% of all the bond issues that we've advised on, that would be thousands of issues, we're done with the level debt structure. And again, as Alex said, if you accelerated the principal repayment, you would reduce the interest expense because you'd be paying back the principal faster, but you'd be burdening the taxpayers with higher impact in those the years that you're paying it back more quickly. So if you went 10 years rather than 15, your debt service on an annual basis would be substantially higher, and the residents have to pay that burden.
Thank you. So, Bob Smith, a lot of these are now geared towards you. First question: is financing for adaptive reuse any different from facadism? Adaptive reuse is 100% interior work, where facadism involves new construction and demolition.
Well, what we would do is we would look at exactly those factors and see just what the project entailed. Interior construction, reconstruction of a building is what it is. If there are two factors going on, if there's a facade, I think we're talking about facadism, we're just leaving the front of the building. Is that a fair statement of what it is? There's nothing happening to it. At that point, you can be building something behind it, and that might be. We didn't get into this detail earlier, but if you build something that is completely fire resistant, there's no wood, nothing combustible in the building. The law provides for a 30-year period of probable usefulness for that structure. And what we can do is, if there's work being done on the facade, we do that separately with a shorter period of probable usefulness, and then ensure that the new building that's built behind, essentially just building a new building behind it, that may qualify for either 25 or 30 years. If it's new construction, even if there's some combustible materials, you still can get 25 years. So there's a long amortization period available for that new construction. If you are making improvements to the building and leaving, say, a quarter of the building standing and then building something in addition, what you would do is put a firewall between the old portion and the new portion, and then make sure that the utilities that are serving the new portion are separate from the utilities in the old portion, and therefore you're confident in the case of a calamity like a fire, the new building will still stand, and that one can get the longer period then and be financed over 30, probably 30 years, most likely. So it is a balancing thing that'll happen, and it's really very project specific to look at exactly what's going on, figure out what the right period is. So I can say. Yeah.
Thank you. So there's a couple of questions that are similar here that relate to option 3 or scenario 3 that was presented. Question is it is proposed that the St. Paul property can be sold to the bond issuer if other than the village and leased back? 2 questions. Is it contemplated that there will be a sale of the total plot, including the playing fields? And the second question is, will the sale be an alienation of parkland and require legislative approval? I can say it's not contemplated right now that the building would be sold and the parkland designation changed. That's not currently being contemplated. Similar question: the property is parkland. Can it be sold and leased back to the village without violating parkland restrictions? Maybe you want to talk about the parkland restrictions with respect to the building?
Yeah, happy to speak about it. I think people are probably generally aware that there was a case years ago involving this property. I mean, I think I'm not the expert on that one. I'll leave it to someone else, village attorney or others. But yes, if there is a restriction of parkland, or I think the judge in that case is a non-parkland public trust kind of a situation, even though it was not deemed to be specifically parkland. Yeah, if that's a factor, we are going to look at that and say we can't do a transaction that will violate that particular trust.
Got it. Maybe a little out of my element, but I know we had talked about in some discussion, the setting up an entity that would be controlled by the village potentially and using that as a conduit. Maybe that was the LDC
That is the
concept,
LDC, right?
but that
Right. Well, I want to mention that even when there's a discussion of the IDA financing, point one, I guess, to your question, that the Local Development Corporation is an entity, a special section of the Not-for-Profit Corporations Law in New York, which authorizes the municipality to create a local development corporation to do certain things, essentially. Economic development and job creation are the things that either an IDA or an LDC would be geared toward. Now there's verbiage in that law that makes reference to lessening the burdens of government, and people interpret that in different ways, and sometimes use a local development corporation in creative ways. And there's no it's beyond the scope of discussion until we know exactly what's proposed to be done with either an IDA financing or an LDC financing. But in a normal course, traditional municipal functions are not financed through something other than general obligation debt. There was a case in the city of Troy, I guess in the 1980s, where they did exactly that. Sold the building, leased it back, and really were just reconstructing their city hall, and that was severely criticized at the time. Now, a lot of other creative things have been done since then with local development corporations, but there's normally a stream of revenue that's developed. There's something there, as was mentioned a couple of times here tonight. There may be a stream to come. Other than potentially, as I think Mr. Blair mentioned, revenue that sort of just covers the expenses of running of the operation is one thing, but more commonly, a local development corporation would be a situation where you're leasing or selling the building to someone like a 501c3 corporation that is going to generate revenues from some other source and pay the debt service. It's hard to conceive of something that would be done in the village, where the revenues are general taxes, general village revenues that would really work in an LDC context. But we're all willing to listen to any suggestions or anything that comes up, but they have to be analyzed sort of on a one-on-one basis. In terms of an IDA financing, it's important to keep in mind that there are statutory limitations of what an IDA can finance, and there may have even been some discussions with the IDA about doing financing. Yes, as Richard mentioned, an IDA would not be limited by the local finance law requirements, but they are limited by their statute and what they can do. And general village functions, I think that's probably no, but it's worth speaking to any IDA about what financing assistance they could give. But I think it's important to keep that in mind, that it's not a blank slate. It's very regulated in terms of what an IDA could participate in.
Thank you. I'll just question. This is another question, but I think you just answered it. For the revenue bonds issued by a conduit, the bonds are only backed by any revenue generated by the St. Paul's project, ? There is no obligation assumed by the village to repay the debt. And I think the answer to
that's right. The term is that they're subject to appropriation. So the state constitution requires that a municipality, when it issues its general obligation debt, it shall do everything it can, whether it's free taxes or other revenues, to pay that debt. And it's required paid. A conduit issuer, would be subject to appropriation. And in theory, if the village failed to appropriate money to pay the debt, it would not have to be paid.
But that revenue would be coming from
But the revenue
tax
would be
revenue.
coming in to pay the debt.
Right.
Yeah.
So now we have just a couple of questions about the special legislation process. I'll read. Question related to the issuance of the 30-year general obligation bonds to fund financing the adaptive reuse option. Page 9 states the village would require special state legislation authorizing issuance of 30-year bonds. The ability to secure the special legislation is not guaranteed and would be time consuming. And to that, there's a number of questions. Please explain the process. Who would be shepherding that process, that legislation through the system? Please define time consuming. How long would that take? And what experience do you have in engaging in such a process on behalf of a New York State municipality? Can you handicap whether the village would be successful if we saw such an alternative? And can this also be pursued for the 10-year demolition PPU?
How big are those cars? Anyway, that's a lot of questions on that one.
That was an online question.
Okay. Well,
You get the drift.
I'll let Richard speak on it also. Again, Richard mentioned having worked on the matter in Long Beach. I mean, we have from time to time, we've drafted special laws for various purposes, very infrequently for this particular purpose, frankly, and if ever. But Richard mentioned the one example. It is out there. The process would be, as I think Richard mentioned before, you need the bill introduced from the Assembly or the Senate. You need a sponsor in each house, a vote in favor, and the signature of the governor, just as it would be with any of the special legislation in the state for any purpose. There would actually be a requirement whenever a special law goes to Albany, there has to be a request from the village by resolution going to Albany saying, we hereby request that this special law be placed, because the distinction is a general law that applies to everyone in every municipality or everyone in the state, as opposed to a special law, which by its terms applies only to this village for this particular project. So there would need to be by resolution a request made for the special law to go up if it is a special law. And I'm not prepared to handicap the likelihood of success. I don't know if you have anything else to add, Richard, but.
Sure. So I will handicap this because I like to handicap things. I understand that. I mean, obviously, we know the building. It's this iconic building, has a great history behind it. It's a landmark building, and I believe it already has historic designation, National Registries. I think the legislature would be inclined to give you a reasonable extension of your useful life for this particular purpose. What they're going to look at, in part, is the nature of what you're funding. Does it merit a special rule? And then they're going to look at how much relief do the residents get by virtue of extending the useful life. And it's going to be significant. Going from 15 years to 30 years is going to significantly reduce the annual impact to residents. And from a sense of equity, the building is going to be around for a long time. That's why you're looking to preserve it. So why shouldn't the residents over the next 30 years pay for it rather than over the next 15 years? I think that'll come into play. So if I had to game it out, I'd say you're much better than 50-50 that you'd get this. How long it will take, it wouldn't get introduced any earlier than January, the new legislative session. Could it get done in calendar 2024? I'd like to think it could. And again, we just did this with Long Beach, and we were successful in getting a much longer useful life for their particular project. And it wasn't as consequential in terms of, preserving something historic as the St. Paul's building certainly is.
Rich, question from me. How far along does the project need to be before you go up for special legislation? Do you need plans and, does it have to be like ready to put a shovel in the ground?
I don't think so.
Not required.
I think they're going to want to know what you plan to do with the project, what you plan to do with the building. And if you make a compelling argument that you're going to put something that's going to be great for the community, it's going to preserve the architectural integrity of the building that's there, and it's going to be enjoyed by residents, and it has popular support, that's certainly very important. You don't have to say this is exactly what we're doing. You have to give them a sense of what you're going to be doing, and that'll help move the legislation along.
Got it. Bob, another one for you, and I think you've seen this already. It was reported by the Committee on St. Paul's preliminary report of March 2023 that any of the St. Paul's projects could be delayed by time spent on the environmental impact study for up to 12 to 26 months, along with time for potential environmental litigation. If these studies and timelines are correct, then how would it affect the timetable for construction and potentially increase costs by delaying the completion of any foreseeable project, or are the above statements false? Question mark.
Statements are true. There is a requirement that the environmental review be done before the bond resolution is adopted, and that comes essentially from the case law over the years in New York. The issue and the reference to SECRA is the law, State Environmental Quality Review Act, commonly just referred to as SECRA. Is a law that requires that anytime a municipal body is doing pretty much anything, that they give what's referred to in the law as a hard look at the project and its environmental impacts. And environmental means not just pollution in the ground or the air, but noise and things like that. Anything that may affect the environment for a new project. Now, there are plenty of exceptions to that, or projects that don't require true analysis. Interior reconstruction of a building, generally no. Buying a truck or something is no. You don't have to do environmental review. It's referred to in the law as a type 2 project. I don't know what this project would be, but I can tell you in response to the question, whatever SECRA analysis needs to be done needs to be complete before the adoption of the bond resolution. And so yes, if there's a delay, I'm not sure where, I guess it said 12 to 26 months, whatever the time period may be. If there's a delay, that would delay the adoption of the bond resolution, which logically then delays the authorization of financing and delays proceeding with the project. So I think that's the answer to the question is that yes, if SECRA takes 2 years to do, then it would delay the adoption of a bond resolution by 2 years. And I leave that more to the project engineers, possibly village attorney, to weigh in on exactly what and to advise the board on exactly what environmental review they need to be doing.
Thank you. So this is the last question I have, and I'm pretty sure we've already covered it, but to be fair, I want to make sure we're reading all the questions. If 10 years is the term for demolition financing, why is it 15 years for facadism when most of the funding will be used for demolition? And what would the financing term for the new structure to be built without the facade? Question mark. Mm-hmm. I know we've kind of
happy to talk about that. That's one kind of dragged in before at the end of my comments. So I hope that I'm making that clear. The project will be analyzed in terms of it has to come to us in a truly proposed form. We're going to do the following to the facade or do nothing to the facade, and we're going to build something behind it that either is fire resistant, is partially fire resistant, or whatever the nature is. And I kind of mentioned that bifurcation of the building, if possible, to separate the buildings by firewall and utilities and things like that to maintain the PPU for the new construction. If that applies, it's very case specific.
Thank you. Just reading last question here. Maybe I'll pass it to Rich. It's about the credit rating and some specific things there. Take a look.
It's a few paragraphs, so we'll start with.
Well, if you want to read it first and see if we've covered it already.
All right. Are there? So yeah, these are good. Are there comparable AAA New York credits that were used to determine financing costs? So we use that MMD scale that we referenced, which is it basically takes all of the sales that occurred the day prior, or, well, as of the day of that analysis at that rating category. So yes, we used comparable anyone that's sold in that category, and I believe it's the whole country, right?
Yeah.
Yes.
There's a question here about the call feature. Over the last several years, when interest rates were extraordinarily low, investors got used to an 8-year call. So the question is, should it be an 8-year call, or should we give investors a 10-year call? The longer call protection that you give an investor, the more comfortable they are with the investment, because they know, for example, when they buy a bond that we issue with an 8-year call, they know for the next 8 years, hell or high water, they're going to get their money back. And then maybe starting in year 9, we might call those bonds in. it's a 10-year call, they get an extra year of call protection. When we go into the market, we'll assess what we think is more appropriate. Presently, we think the difference between an 8-year call and a 10-year call is pretty negligible. The market expects an 8-year call. That's what we've been selling our bonds at for the last probably 7 to 8 years.
There's a question about direct purchase by a bank. I'm thinking I might want to answer that. Versus a competitive sale.
Sure. So the next question, so we could sell this under New York State local finance law, under the controller's regs, bond debt in excess of $5 million has to be sold a competitive sale. The question was whether we could privately place this with the bank. I suspect when we go to get, if indeed we get the PPU extended from 15 years to 30 years, at the same time, we could ask the legislature to give us the option to finance the debt either at competitive sale or via negotiation. If indeed we sold the debt via negotiation, what we would do would we put a request for proposals, interview underwriters, and then select an underwriter that would bring us to the market. I would argue rather strenuously for a general obligation AAA credit, selling it competitively is your better option. But again, as time passes, as market conditions change, if indeed we think it would make more sense to negotiate this, we're certainly not adverse to doing that. If, of course, we think it'll get you a better result.
Great, thank you. For folks on Zoom, once again, if there are any questions, you can email St. Paul's questions at gardencityny.net. We may have some questions. Question is, how would we fund change orders and overruns if the bonds are based on an estimated cost and does not cover such extra costs due to unforeseen conditions?
About that. Yeah. That's the reason why I mentioned when I talked about the contents of the bond resolution earlier, use that statutory term, estimated maximum cost. That's the meaning of the word maximum. It makes sense to authorize an amount that's high enough. If it turns out, something change or beyond that changes, you need to amend the bond resolution or adopt a supplemental bond resolution. If need be, that's the way to do it. If the bond resolution authorized $10 million and the project comes in at 11 and there's no way around it, the only recourse is to adopt an amending bond resolution, increase the amount from 10 to 11, and run through a permissive referendum period or a mandatory referendum period. Start that clock again. So it'll take a couple of months to know that you have it authorized. But that's really the only solution at that point.
And let me add this. The cost of the project, that's determined by your architects, your engineers, construction managers, etc. They tell us how much debt we have to issue to fund the project. And when they give us their numbers, they build in contingencies. They factor in the fact that it's going to be built over a period of years. Maybe there's a 3% annual escalator, etc. So they size the issue in anticipating that there might be overruns, slowdowns, prices will go up over time, etc. So again, the maximum cost in the bond resolution is you can issue up to that much debt. You're not required to issue up to that much debt. Once you bid it out, then you pretty much lock in your numbers. We know there can always be changes, but again, the architects, the engineers, the construction people factor that in before they give us their numbers.
Thank you. Irene, there's a question for you. Page 1 of the presentation of the anticipated general obligation bonds, bond issues in 2024 of 13 million. How much is new and how much is refinancing of maturing debt?
Oh, none of that. All of that is new projects. None of it is refinancing of old debt.
Okay. And for the CMA team, page 8, rate assumption for 2025 15-year AAA bond is 420, which includes 80 basis points or 80.8%. does the 80% mean basis points?
Yes.
It does.
Yes.
Yeah, 80 basis points.
It also says, I cannot reconcile this interest rate with the rate table on page 17.
Oh, that it doesn't match
Oh,
the MMD?
15-year.
Well, to start, like we mentioned, well, I don't know if we actually mentioned, but so with serial bonds, what this table is showing isn't a 15-year bond would go for 3.67% for a AAA. What it's saying is the first year maturity would be a 3.42, the fifth year would be a 3.1, and so then that's blended. So likely, if we would have sold on September 21st, the 15-year rate would have been less than 3.67. So then when we add the 0.8, it gets to 4.2. It's not, 4.2 minus 0.8 isn't, was that 3.6, 3.4, which is less than 3.67. That's because it's blended rate.
Okay, thank you. This question from the room, is the illustrative 50 million financing amount consistent with the estimated cost to fully develop St. Paul's? I think I can answer that. The answer is no. The numbers we used here, the 50 million, 7,500, those are illustrative, directional numbers. We'll get more into the weeds on the Westerman report numbers at the session next Tuesday. So, any other questions? If there's no other questions, I think we can wrap it up. I want to thank Bob Smith, Richard Tortora, Alex, Diane Castaneda, and Irene. Thanks, guys. It was a fantastic presentation, and clearly, you guys are very knowledgeable with the subjects.
Thank you.
Thank you.